Welcome everyone. Today we are going to start next chapter of grade 12th accountancy, that is dissolution of partnership firm. As you can see on your screen that the company is now dissolved and probably the business has come to an end. There are two types of dissolution. One is dissolution of partnership and other is dissolution of partnership firm. When we talk about dissolution of partnership, that means the agreement between the partners have come to an end and maybe new agreement is designed. While the dissolution of partnership firm means totally completion of the business and non continuation of the business enterprise. Dissolution of a firm is entirely different from dissolution of partnership. Dissolution of firm leads to complete closure of a business. In case of dissolution of partnership, the business may continue with a new agreement, but in dissolution of firm, the business will not continue. All the assets are sold and liabilities are paid off. Dissolution of partnership. Any change in the relation between partners lead to dissolution of partnership. At the time of change in profit sharing ratio between partners, admission, retirement, death, etc. The partners cause change in the relationship between partners. In all these cases, the dissolution of partnership takes place and not the dissolution of partnership firm. That means there is a edit or there is a change in their agreement of profit sharing and their management. At the time of dissolution of partnership, the business can continue with a new agreement. The reasons for dissolution of partnership that we have seen in our previous chapters, they are admission of new partner, retirement or death of existing partner, change in profit sharing ratio among partners, amalgamation of firms. In the above cases, the firm can continue its business with a new agreement. There is no need to disclosure or dissolution of firm. Now we'll talk about dissolution of firm. That means a complete closure of a business. Dissolution of a firm, also known as winding up of a firm, results in termination of relationship between all partners and stoppage of business. At the time of dissolution of firms, all assets of firm are sold, cash is realized, and with that cash, the liabilities are paid off. If there is any cash balance left, it will be distributed among the partners as per their profit sharing ratio. They decide to close the business, they sell the assets. From the amount that is realized from asset, liabilities are paid off. If there is a negative balance, that is also again borne by the partners. And in the reverse case, if there is a positive balance, that is also again distributed among the partners. There is sometimes the realization expenses that is also borne by the firm. Sometimes it is borne by partner and the liabilities and assets are also taken over and paid back by partners themselves. Dissolution of partnership and dissolution of partnership firm are two different phenomena. Where the dissolution of partnership, there is a change in relationship among the partners. In dissolution of partnership firm, the firm comes to an end. In dissolution of partnership, there is no termination of business. The business can continue with new agreement. On dissolution, the business will not continue and comes to an end. Assets and liabilities are revalued at the time of dissolution of partnership. Assets and liabilities are paid off. Assets are realized and liabilities are paid off in case of dissolution of partnership firm. The economic relationship among the partners often change in dissolution of partnership. The economic relationship comes to an end at the time of dissolution of partnership firm. Preparation of balance sheet. Assets and liabilities are revalued and new balance sheet is prepared. In dissolution of partnership firm, there is no scope for preparing the new balance sheet as the assets and liabilities are closed. In dissolution of partnership, revaluation account, capital account, cash and bank account, and new balance sheet are prepared. In dissolution of partnership firm, only realization account, capital account, and cash and bank account is prepared, which will be at the end tallied. Modes of dissolution of a firm. What are the reasons for dissolution? One is dissolution by agreement. Next is compulsory dissolution. Next is on the happening of any contingency or emergency. Dissolution by notice. Dissolution by court. Sometimes because of the standard instructions or by the rules or verdict of court, the dissolution has to be taken place. First, we will be looking at the dissolution by agreement. With the consent of all the partners, it may happen that when all the partners agree on dissolution of partnership firm, that is to be taken into consideration. With the consent of all the partners, that means when all the partners decide that there is no scope of continuing the business, they will dissolve the partnership firm. As per the terms of partnership agreement, when the business was started, when the partnership was started at that time, they might have agreed that after so and so years or after so and so period of time, there will be the dissolution of partnership. So that is again as per the partnership agreement. Compulsory dissolution when a business of the firm becomes illegal, when all the partners or all except one become insolvent, when all partners or except one decide to retire from the firm, when all the partners or except one dies. So on death, on illegal business, on being insolvency, the dissolution should be taken place. Modes of dissolution of the firm 3, that is on happening of certain contingencies or any emergency. On the happening of absence of agreement, a firm has to dissolve if the constituted for a fixed period by expiry of that term. That means in agreement they have mentioned that the partnership will last till so and so date and still the partnership is going on, so that is to be dissolved if constituted to carry out one or more ventures by completion thereof, by death of a partner, by declaration of a partner as insolvent. So if they are doing any business that is not confined to their area, but it is also into some other ventures, at that time they have to dissolve it on death and on insolvency. Next is resolution by notice. In case of partnership at will, the firm may be dissolved if any of the partners give a notice in writing to the other partners signifying his intention to dissolve the firm. So any of the partner can give the notice that the firm should be dissolved. Now very important is dissolution by court. When a partner becomes of unsound mind, when a partner becomes permanently incapable of performing his duties as a partner, when a partner transfer whole of his interest in the firm to the third party, when the business of the firm is can't be carried on at a loss, when the partner commits breach of agreement relating to the management of the firm, when, on any ground, the court regards dissolution to be just and equitable. So these are the compulsory dissolution and given by standing instruction of court. Dissolution by the order of court. Now we'll see that how the books of accounts are settled at the time of dissolution of partnership firm. Dissolution of firm means complete closure of the business. So on dissolution, the firm disposes of all its assets for set of its liabilities. The mode settling accounts will be mentioned in the partnership deed. But in absence of an agreement between partners, the rules given in the section 48, 49, and 55 of the Indian Partnership Act 1932 will apply. These results are treatment of losses. Number one, losses including deficiencies of capital shall be paid out first of out of profit, next out of capital, and lastly, if needed, by the partners individually in their profit sharing ratio. That means when if the firm is under a big liability, at that time the priority is given from out of profit. That means whatever the firm has earned profit, out of that profit, the liability is paid back. Then the capital which is invested, so the assets are to be sold off and amount is to be paid. Still, if there is a liability, then partners have to pay from their personal amount in the profit sharing ratio. Application of assets. Assets of the firm, including any amounts contributed by the partners to compensate deficiencies of capital, must be applied in the following manner: paying the realization expenses, paying the debt from third parties, creditors, loans, bills payable, bank overdraft, loan from partners or their relatives, repayment of loan from partners, repayment of capital contribution of the partners, surplus, if any, is distributed among the partners in their profit sharing ratio. So these are the stages. First of all, they have to pay the realization expenses, then they have to pay the debts, then they have to repay the loans. After that, whatever capital contribute capital contribution, that is the balances of capital account, shall be concluded, and still if there is a surplus, that amount should be divided among the partners in their profit sharing ratio. Next is settlement of private debts and firm's debts. Now, private debts are the amount that a partner owes, and firm's debt is the amount that a firm owes. So, obviously, the priority should be given to firm's debts, and then the personal debts or private debts are to be paid. Accounting treatment. These are the three important accounts that are to be prepared while doing the sums numericals of dissolution of partnership firm. Number one is realization account, next is partners capital account, and third or the concluding account is cash and bank account. The realization account consists of all the valuation of assets and liability. It is a nominal account. It is prepared at the time of dissolution of a firm. Realization account is prepared to close the accounts of assets and liability and to find out profit or loss on realization of assets and repayment of liabilities. All assets except cash and bank and fictitious assets are closed by transferring it to the debit side of realization account as its book value, and external liabilities are closed and transferred to the credit side of realization account at its book value. Any provision relating to assets and liability must also be transferred to realization account. Amounts realized or assets may be taken over by the partner should be credited, and liabilities settled down or again paid off by the partner should be debited to this account. Realization expenses should be debited by this account, whether it is paid by partner or it is borne by firm. At last, this account is closed by transferring the realization, profit or loss to partner's capital account. Following other journal entries, first of all, transferring the assets to the debit side of realization account debited to assets. Next is when the external liabilities accounts are closed and transferred to realization account. The journal entry is liabilities account debited to realization account. To close the provision against various assets, if any, provisions for doubtful debts, depreciation, joint life policy reserve, contingency reserve, investment fluctuation fund. Either of this may be there in the numerical question or maybe the combination of any two. All these are to be written on the credit side of realization account. So these provisions should be debited to realization account credited. To close the provision against liabilities, it should be on the debit side of realization account. So realization account debited to discount on creditors. When assets which are listed in the realization account are sold, cash and bank account debited to realization account. The values for various assets should be mentioned in the inner column of realization account. When assets are taken over by any of the partner, so that partner's capital account will be debited to realization account. Amount will remain same at what value the partner is taking of the assets. When liabilities are paid, realization account debited to cash account. When liabilities are also paid off by the partner, then realization account debited to the partner who has paid the liability. When realization expenses are paid, realization account debited to cash and bank. Same way, when realization expenses are paid by the partner, realization account debited to particular partner's capital account. When the amount realized from unrecorded asset, sometimes certain unrecorded assets are not mentioned in the balance sheet, but they are given as additional information in adjustment. So that is also to be taken into consideration, and effects are to be given. Cash and bank account to realization account if it is unrecorded asset. Same way, when the unrecorded asset is taken over by a partner, partner's capital account debited to realization account. There are sometimes unrecorded liabilities also, so treatment should be made for that. Realization account debited to cash and bank account if the unrecorded liabilities are paid off by the firm. Same way, when the unrecorded liability is paid off by the partner, realization account debited to particular partner's capital account. When there is outside settlement with liabilities to unrecorded asset, that means when unrecorded liabilities are settled with unrecorded asset, at that time no entry is required. Now the realization account should be closed, so that amount is either profit or loss of at realization of assets and liability, and that is again transferred to partners capital account in their profit sharing ratio. and we will see one pro forma of realization account. Now the realization account, you can see here on the debit side, all the assets that are to be closed should be mentioned in their book value. Same with the provision against assets. Then next important thing you have to do is on liability side, all the liabilities should be listed and provision against the liability should be listed. Then the cash. Here you can see whatever cash we are paying for liability should be written on the alternate side, that is on the debit side. And same way, whatever cash is realized on sale of asset should be mentioned on the alternative side, that is credit side. The liability is taken over by the partner. For that also it should be debited. Same way the assets taken over by partner should be credited. Now realization expenses, cash from unrecorded assets, cash paid to unrecorded liability. All these things should be mentioned, should be recorded in an alternative manner. Once we have listed the liability, the amount paid for the liability should be on the opposite side. Same way, once we have listed the asset amount that is realized should be written on the credit side. Now, when we balance this amount, this account, both the side, either there will be a profit or there will be a loss that should be distributed among the partners in their profit sharing ratio. Now we'll see how to prepare or basic journal entries of partners capital account. Very important thing in partners capital account will be partners loan. If partner has advanced any loan to the firm, his loan account should be settled by giving the journal entry partner's loan account to cash. As you can see on your screen, payment of partner's loan account debited to cash account in his respective capital account. If partner has taken loan from the firm, his account will be again settled when partner pays the amount to the firm. So the journal entry will be revert over here. Cash and bank account debited to partner's loan account. If the partner maintains current account at that time, current accounts should be closed and transferred to partner's capital account. So partner's current account debited to partner's capital account if it has a debit balance, and same way if it has a credit balance, the journal entry will be reverse partner's capital account debited to partner's current account. So in both the cases, if partner current account is maintained, that is to be closed and transferred to partner's capital account. Now the partner's capital account should also be closed and transferred to cash and bank account. As in the dissolution, the firm is not going to continue, there won't be any liability, so the cash and bank account will be closed and the amount should be either paid off or taken from the partner as the case may be. So for closing of partner's capital account, if it has a credit balance, partner's capital account debited to cash and bank account. Same way, if it has a debit balance, cash and bank account debited to partner's capital account. If you're posting it, it is called alternative entry. Now, the last and very important thing, if there is any goodwill of partnership firm, how it should be treated. No special treatment is required because goodwill is treated as an ordinary asset, and the amount that is realized after selling of the goodwill will be credited to the realization account. That's all for dissolution of partnership firm. Thanks for watching.